Welcome to Beacon Wealth Spotlight Series, where we discuss a variety of investment and financial planning topics. In this episode, we focus on estate planning and some of the issues we get asked around probate and taxes. Please note that this video is for general information purposes only and is not intended to replace legal or accounting advice. Hello, I'm Jack Fournier. This is Travis Kidson. We are Beacon Wealth Partners, and this is a video in our continuing series, Spotlight on Financial Matters. We've been getting a number of questions about probate and estate planning, and we thought it a good idea to create this webinar. Upon the death of a last parent, it's a very emotional, traumatic experience. Assets get distributed according to the will, and mom and dad are not around anymore to explain what's happened. Family dynamics come to play here. It can be very emotional, it can be very difficult, and cause some serious hardships. And so it's important to understand sometimes the unintended consequences of actions that may be done in the best interests, intentionally for the children. We are going to use cue cards. We are not actors. I get more and more respect for people who can do this on camera all day long. And so if you see us referring to this, it's we're just trying to keep ourselves on track. We find it easier to use an imaginary family, put names to things. And so we're going to do that in a minute. We're going to focus on 4 areas in this webinar. They tend to blur together, so it's not a specific chapter for each item, but these are the topics we want to talk about. Probate is the first one. What is probate? How does it work? We're going to talk about how assets are taxed. We're going to talk about joint ownership of assets, and we are also going to talk about beneficiary designations. Travis, can you start us off with explaining what probate is and how it works?
Probate is a public process whereby the provincial courts are responsible for certifying the final wishes and will of a deceased individual. In British Columbia, there's a 1.4% fee that's charged on an individual's estate above and beyond $50,000. We tend to get asked, are there ways that we can avoid probate by clients? And in our opinion, we feel generally that you're better served to try and organize your financial affairs beforehand to help reduce some of the taxes that you may have to pay. Because in our opinion, probate, its process, and the charges associated with it, we just consider it a user fee. It's a really important process that the courts go through because it does ensure that the deceased individual's assets are distributed according to their wishes. You may be wondering, well, how does the probate process happen? How does it start? When an individual is going through the process of creating their will, one of the responsibilities that they have to do is nominate either one or a couple different executors. And the job of an executor is to gather all the individual's financial documents, submit them to the courts, and that begins the probate process. As I had mentioned, probate is a public process, so the court does allow institutions like creditors or CRA to come in and collect any final liabilities or taxes that are owed on the deceased individual's estate. And the executor's job, in part, is to ensure that those charges are paid out. Upon that process, the court will then approve the distribution of the individual's estate, and then the executor will then distribute those assets according to the deceased individual's will. We often get asked by clients what types of things can be included in the probate process. So generally speaking, personal use items like clothing or furniture is omitted, but you can have instances where antiques or artwork are. But the reality is, for the average family, it typically is real estate, your investment accounts, and bank accounts. You can have instances where an individual will have name the beneficiary on some of their assets. Generally, you can do that on things like life insurance policies or registered investment accounts. In these circumstances, those assets will actually bypass probate and the fee, and they go directly to the beneficiary that individual has named. Depending on where those assets came from, taxes may still have to be owed, but it does bypass the probate charge. So, you're one of the things you may be thinking is, well, probate seems like a fairly intensive process where there's lots of things going on. Generally speaking, executors that family members or individuals name on their will are children or friends and family. But it is important to note that they're not alone. They do have the ability to hire professional help like accountants or lawyers to help ensure that the probate process goes smoothly. So as I mentioned before, one of the things that we think is a bit more important for individuals to focus on is reducing your tax bill upon your death. And so Jack is just going to help provide some clarity on how your assets are taxed upon your death.
Okay, so let's talk about a case study. We've got Mary and Bob, they're seniors, they've got 3 adult children, a number of grandchildren. Generally, women outlive men. When Travis and I do a financial plan, we usually kill off Bob first, and then everything passes over to Mary. It doesn't really matter which one dies first, but the same rules apply here. So upon Bob's death, usually, there's a number of assets. So usually there's a home, it's in joint tenants with rights of survivorship, which means they each own 100%. When Bob dies, Mary now is the sole owner. They might have recreational properties or a rental property. The same rules apply. There's an embedded capital gain potentially. Mary can elect to defer that taxes. Bob's name is removed and she's the sole owner. His RSP is going to roll over to her, or a RIF is going to roll over to her. Now she does have to file an election to defer the taxes, but she can do that. Tax-free savings account, again, she's successor holder, no taxes anyways. It all moves into her account. And then a non-registered investment account. Upon Bob's death, again, through the will, she's going to roll that over into her account. She gets to elect to defer any taxes. Now, any interest or rental income or whatever else is owed before Bob's death, that's added to his income. The capital gain is added potentially to his income, but she gets to usually defer that tax. Thus, we are mostly concerned what happens upon the second death. We're concerned when Mary dies and what happens then. And this, of course, is where all the issues, and Mary's not around here to explain things anymore. So upon her death, principal residence, no tax. She has the rental property or recreational property, all that capital gain is now taxable to her, 50% inclusion rate. The investment account, if they have one, again, capital gain, 50% inclusion rate to her. Tax-free savings account, there's no tax on that. If she has a life insurance policy or they had a joint last to die life insurance policy, most of the time there's no tax on that. It's just the RIF or the RSP we're concerned about. And if you have a very large amount of money left in your RIF, then that can be a very large tax bill. So we add everything up all together, there's potentially a very large tax bill. And part of what Travis and I tend to do for our clients is look at how do we reduce that tax bill through our retirement plan and as part of the estate plan sort of thing. So, and we will focus on that in another Spotlight series webinar. So Travis, got a bit of an idea how the taxes work. Bob's gone. Mary's concerned about probate. Can you walk us through a couple of things people might be asking us or tend to do in this situation?
Yeah. So now going back to some of the things I had mentioned in the past where we typically get asked by clients, how can we mitigate our probate bill? And so again, going along with what Jack had said, Bob has now died in this example, and Mary now elects to add her daughter Jane on joint title of Mary's primary residence. Her daughter Jane lives somewhere else, and so in the eyes of CRA, Jane's primary residence isn't Mary's primary residence. And therefore, upon Mary's death, 50% of any growth that Mary's property has will be added to Jane's taxable income that year. For the purposes of this example, let's assume that the value of Mary's primary residence is $1 million when Jane gets added to it. Fast forward a few years later, Mary now dies, and her property is now worth $1.5 million. Because Jane is the joint owner on Mary's primary residence, probate has now been able to be avoided. That probate fee would have been about $21,000. However, because Jane has a primary residence elsewhere, she's now responsible for paying half of the capital gain on Mary's primary residence, or $250,000. And so in these instances, one of the things that individuals have to be careful of is that the tax consequence that Jane now has to pay could be greater than the probate fee that would have been owed had Mary just kept the primary residence in her name. But there's a bigger issue. As we had mentioned before, Bob and Mary have 3 children. By adding Jane onto the property is now flown into Jane's name after Mary's death, and it will then bypass the will. And so without intending to do so, Mary has now disinherited her other 2 children, and Jane is now the sole owner of this property. So let's look at another example, and this is probably one that we find is a bit more common in terms of the questions that we get asked. Generally speaking, parents will also ask us, can we add our children as joint owners on their bank accounts? And in these particular instances, we're not necessarily worried about the tax consequences, but the issue of disinheriting your other children is still there. So the challenge that we can see is if Mary were to add Jane or another one of their children onto her bank account, those other 2 children can get disinherited upon Mary's death. And from personal experience in dealing with clients and families, Jack and I have seen circumstances where very small amounts of money can still tear a family apart when children get disinherited unintentionally. So we've talked about some of the consequences of what can happen when parents add children jointly onto their assets. Bob has passed, and Mary has now inherited all his assets. What are some of the consequences if Mary adds her children or her grandchildren as beneficiaries on some of her registered accounts?
Good question. Okay. So after Bob's death, Mary, thinking about her RIF and TFSA, she decides she's going to name her children as beneficiary here. That would avoid probate. Tax-free savings account, no problem. There's no tax consequence to her, so all the money is going to flow to her children. Very simply. Very good. The RIF could be a little more complicated, and we have to think about the tax consequences of what's going to happen. So if we imagine she's got $400,000 or $500,000 in her RIF, that's a pretty good tax bill to her. If she names all 3 children, and if that's the only asset she has, and there's somebody else is the executor, or maybe it's one child is the executor. Now, all the money passes to the children, but the executor has to pay the tax bill on it. Where is that money going to come from? If all 3 children are executors, they each are responsible, so not a problem. But usually it's just one of the children or somebody else is the executor, and that could be an issue. If there are other assets, like we talked about, maybe her having non-registered investment accounts, then there could be money there to pay that bill. It's something you need to think about. It's something that needs to be reviewed on a regular basis just to make sure you're not leaving a liability or causing a problem for your family down the road. Other thing people think about is, okay, how, I want to leave some money to my grandchildren. If you're doing it, you can do it directly through your will, or maybe you can put the tax-free savings account, name the grandchildren as beneficiaries, or is another way of doing it. Upon Mary's death, the assets are going to be distributed to the grandchildren. Now, if they're under 19 in BC, they're not legally able to inherit. Trust has to be set up for them. So that can be done through the will, but wouldn't be done through the TFSA. The other question is, what happens if they're not particularly good at money? Young people often aren't good with money, and if the idea was that this was going to help them build a future, giving them all the money might not be the best idea. If it's just to give them a little bit of money so they can spend it, no problem. But it's something you need to be aware of and think about. Travis is going to talk about another issue that we face in our modern world, blended families.
So if we go back to the case study of Mary and Bob has died, and let's now make the assumption that Mary decides to remarry. Mary wants to ensure that her 3 children are looking after or are taken care of, but also wants to make sure that her new partner has some funds there as well. So how can she set up her estate effectively? If she nominates her 3 children as beneficiary, her new partner won't receive any assets. And similarly, if she names her new partner as beneficiary on all her registered accounts, she'll disinherit her 3 children. So she has to be careful. In these circumstances, generally what we find is seeking professional legal advice is the best way of approaching the situation. Lawyers will be able to identify what Mary's needs are and wishes. In some instances, they may even elect to set up a trust to ensure that the assets are distributed according to what Mary would like. There can also be circumstances where a life insurance policy can be an extremely powerful tool. This would allow Mary to nominate multiple beneficiaries and ensure that all the parties are taken care of. We generally recommend this for all families, but in particular when you have a blended family or there's a remarriage, it's really important that Mary has a conversation with each individual in her family. This gives her the ability to clearly articulate what her wishes are, and it just helps maintain the family harmony because everyone is in the know. So we've covered a number of things today. As always, if you have any questions, give Jack and I a call. We're happy to help. Stay tuned. We're going to be releasing more of the Spotlight series on retirement planning and estate planning, and we'll let you know once new videos come out. Thanks, everyone.
Take care.